Okay, welcome to Chapter 8. We are going to learn all about inventory, and you guys are going to love this because everything that we learn in this chapter, pretty much except the stuff that relates to Chapter 6 a little bit, but not much, is something you learned in intro. So you'll be able to bring it forward and relearn it or re-remember it, and it's a nice little chapter. Okay, so we're still dealing with the asset balance sheet. Now we're dealing with inventory. We've done cash and so on. Now we're going to do inventory. So we're going to look at the definition of inventory valuation methods, in periodic perpetual inventory systems, lower of cost value, you've probably seen it, LCNRV, and inventory turnover ratio and days to sell ratio. So these are some ratios we're going to look at that are very similar to the AR ones we looked at, but it covers ratios. So they mean the same kind of thing. It's just looking at inventory rather than AR. So inventory is a current asset, as you know. A merchandising company has at least one inventory account called merchandise inventory. And as we learned in Chapter 6, may also have a return damage inventory account and estimated inventory returns. So that's totally from Chapter 6. Cost of inventory sold goes to cost of goods sold on the income statement or statement of financial performance. Now, a manufacturing company, as you know from managerial accounting, will normally have three accounts: raw materials, work in process, and finished goods. And they'll also have a cost of goods manufactured, which is used, which is similar to cost of goods sold. We're not going to spend a whole bunch of time on the manufacturing entries and stuff. We'll leave that to cost account. But we just want to remind you there's also financial accounting, also manufacturers. So costs included in inventory. So remember how when you did assets a while ago, you wanted to know what went into the T asset. Well, same thing here. What goes into our little inventory T account on our balance sheet? Well, us to purchase, convert, and bring inventory to its present location and condition are included in the inventory T account. So all those costs would get added in here. So purchase discounts, obviously your inventory doesn't cost as much if you get a discount, and vendor rebates, so they give you some % off for buying, if they're probable and reasonably estimated, must be removed. Now, we talked about the gross and net method of selling. You can do the same thing for purchasing inventory. But the key point where you want it to be removed would be at year end or statement when you're doing the statements. So we're not going to focus too much on that. And product conversion and borrowing with some restrictions costs. Standard costs as you learnt in cost accounting, so material, labor, manufactured. And cost of service providers' work must be included. Costs that aren't included are storage costs. Now this is particular here, unless they're required between production processes. So for example, if you are a winemaker, wine producer, that's an N, not wire. So if you are a wine producer or cheese, all those need time to sit. So storage while aging. Storage while aging, because it's part of the production process, you have to let it sit there for years or whatever, then it would be included. Wire producers, on the other hand, they don't have to let the wire age. So while it's sitting there on those big reels and it's just waiting to be sold, that storage cost isn't required between production processes. So, things that are not included are abnormal spoilage or waste of any production costs when inventories are ready for use. Interest costs before is okay, but not when they're ready for use. And period costs, which are what kinds of costs? Selling, general, or admin. Now, IFRS, interest costs are included as a product cost if the manufacturing inventory takes a long time. Otherwise, the company has a choice to capitalize interest costs. So under IFRS, you can capitalize it or not. If it takes a long time, then you should, and it makes sense to include it. Under ASP, either capitalized or expense, but you have to disclose the policy. So, which physical items should be included in your inventory? And again, we are talking most importantly at the end of a reporting period where you are doing statements, but in general, that's where you'd spend a lot of time at where your inventory is for your statements. As all of you know, if you've ever taken an inventory count at work. Okay, generally, inventory is included on the balance sheet of the entity that has legal title to the goods. So the company that has the risks and rewards of ownership. So goods in transit. Check for FOB, destination, or shipping. Okay, so obviously if we ship goods and we transfer FOB, free on board, just tells you where it's transferring ownership. And let's say we do it at shipping point. Who owns it when it's in the middle of the ocean after we've shipped it? Customer. Okay? So the customer would have it on their books. If it was shipping, yes, the customer, if it was destination, it wouldn't transfer ownership till it gets there. So in the middle of the ocean, it would belong to us. Okay? Now, as you learnt a little late, I think chapter 6 or 7 was a little late, consigned goods are the property of the consignor, the original owner, okay? Goods sold under buyback agreements. Okay, the seller has the inventory. The last one on this page, goods sold with high rates of return that can't be estimated. Okay, that would be included in our inventory. Sure, we've sold them, but we have no idea. They come back and we know it's going to be a lot. Okay. Conversion costs based on normal capacity. So, direct labor and allocation of overhead and variable overhead. Installment sales. If collectability is guaranteed or likely, so remember installment sales, you do it kind of like pay over time. You can think of it as, if it's guaranteed or likely, as soon as the goods are sold, the ownership is transferred. So it would belong to your customer. Okay, so what I've got here is example 1, which is actually exercise 8.3. So I want you to pause, and we're going with ASPE, and it tells different items of inventory that could be inventory. So we want to know if we were like the original owner of the inventory, Indicate which of these items would be reported as inventory on our books. Okay, in our little T account called inventory. So hit pause and try these out. The rest, I think there's 23 or something. In total, the rest are in the text and the solutions on Blackboard. But try these and then we'll talk about them and go through them. Okay, so if we had goods out on consignment at another company's store, who owns them, us or them? So should it be on our inventory? Yes, it would be on inventory. On our inventory, that's what the S means. Goods sold on an installment basis. So are they going to be on ours? So what does it say up here? If collectability is guaranteed or likely, as soon as the goods are sold, the ownership is transferred. Now they didn't say whether it's likely or not, which is a problem sometimes with these questions, right? Because then we can assume too much. But you're heading to the CPA, some of you, and one thing you'll notice about their questions and their case so on, there are a lot of things left unclear. So when you're doing cases, try not to assume too much. Now, if this was a big part, let's say this was a little case. This is a big part. It's one whole piece. So we could say in our answer, yes, it would be if collectability is not guaranteed or likely. So it would be ours. Or if it's guaranteed likely, then no, it's not ours. Okay? So I'm not going to read anything else into it. It says goods sold on an installment. They didn't qualify. Generally, you're going to sell the goods when you have likely or guaranteed collectability, right? So let's go with that. So we sold some goods on an installment basis. Who does it belong to? Does it belong to us? No. So not on our books. On the customers. Now, goods purchased, so purchased, we bought them. FOB shipping that are in transit at the end of the year. So they're out in the middle of the ocean somewhere. Or across the country on a truck. Who knows? Purchased FOB, so shipping. When does ownership change? Shipping. And we're purchasing, so they're being shipped to us. So are they ours already? Yes, because ownership changed at shipping. So yes, changed at shipping. Now, goods purchased, don't forget sold, that's different, right? Goods purchased FOB destination that are in transit. So we purchased some inventory, some goods, and FOB destination. So where does the ownership change? At destination, that's when we get it. Well, do we have it yet? So it's not ours. Okay, goods sold to another company with SUCAS, that's us, apparently. Having signed an agreement to repurchase the goods at a set price that covers all costs related inventory. Okay, so the minute there's a repurchase agreement, that's a buyback. So, there's a buyback clause from us and we're SUCAS, okay? We're going to repurchase them. So are they ours? Yes. So this is a yes. Just checking the time. Okay, we should be able to get this done. Goods sold where large returns are predictable. So we sold some goods. We know there's going to be large returns. but they're predictable. So should we keep them on our books just in case? No. Because it's predictable, we can estimate it like we did in chapter 6. So no. We can remove them.